Good morning, good afternoon, good evening, wherever you may be in the world, and welcome to another in our series of FIPP webinars. I think this is the fourth one we've run this year, and it will be the last one for 2020. So thank you very much for taking the time and coming and joining us today. And today we're going to be talking about one of the most consistently important areas for magazine media, something that's been the focus of attention for most of our members over the last few years, and that is, of course, digital subscriptions and paid content. I'm delighted that we're going to be joined today by an expert from Piano, who are our strategic partners for this video, our sponsors for this video today, and we really are looking forward to hearing from them later on. We're going to do a little bit of an introduction to our speaker in a minute, but before I do that, I wanted to just talk about, first of all, the format of this webinar and the housekeeping items. We're going to have this in two parts. Firstly, I'm going to spend a few minutes just showing you some of the latest trends from our Global Digital Subscription Snapshot that we've produced in collaboration with our friends at Piano. And then after that, we're going to hear from our guest, who's going to talk about some of the forward-looking trends that Piano are seeing in media at the moment under the general heading, The Next Phase of Media. Before we come on to the key presentations for today, a few quick housekeeping items. You will have noticed that this session is being recorded. We will edit the video together afterwards and put it onto our YouTube channel. You can find us on YouTube at FIPP World. So if you missed the session or you want to share it with colleagues or friends, you can always come back in a week or so's time, find the edited session and share it through the YouTube channel. You will notice as well that at the bottom of the screen, there are two buttons that you can press. The first one is chat and the second one is Q&A. In the chat box, we will be posting some useful links throughout the session, both from FIPP and from Piano. So do keep an eye on that as we go along for some of the links that relate to some of the items we're going to be discussing today. And then, of course, you can, as we go along, ask questions using the Q&A button, which you can also find at the bottom of the screen. And we will take those questions at the very end of the session after both presentations have finished. A lot of what we're talking about today is taken from the Global Digital Subscription Snapshot. The Q3 edition of that was released a few weeks ago and is available on fipp.com. If you look in the chat, you'll find the link there to go and download it. It's free for FIPP members. For non-members, you have to register and join as members, but it is a fantastically useful resource, and you're going to see some of the key data from that in our session later on today. We're going to come back to our guest very, very shortly, but let me just introduce him now at the beginning of the session. He is the EVP Strategy and Social at Piano, and he is, of course, Michael Silberman. Michael, welcome.
Thank you, James. Pleasure to be here.
Fantastic. Great to have you with us. Michael, we're going to come back to you in a moment, but before we do, let me just start with the data that we see from the most recent edition of the snapshot. You can tell by the way that I've got a bit of a cough, so apologies for that if I do start coughing halfway through. I haven't got COVID, though, as I discovered from taking a test the other day. So let's dive straight into the latest data that we've seen from the Global Digital Subscription Snapshot. This is taken, as I said earlier, from the Q3 edition of the report. We aim to produce 4 editions of the report throughout the year. The next one, the Q4 report, which relates to the data that we see at the end of 2022, will be released in January of next year. So look out for that towards the end of January. And we will run another webinar then to discuss the results from the Q4 edition. Normally, 2 of the editions throughout the year contain more analysis at the front. This is one of the data set versions, which is the shorter version. So we haven't got quite as much analysis. We've got more data to talk about this time. So if you go onto the FIPP website, you can find all the previous examples of the report. And of course, all of those are produced in partnership with our friends at Piano, who are here with us today. So here you can see the cover of the report. This is what you need to look for visually. When you go onto the site, you will see that on there, and you can then go and download it. So before we start, I wanted to do what I always do at the beginning of these sessions and remind you that not all paywalls are created equal and not all paid content models are created equal. This is taken from a report we did last year looking at all the different types of paid content strategies and digital subscription strategies that exist in our industry, and it highlights the different nature of the paywalls and the paid content models that many publishers are using. I won't run through all of these in turn, but the key point here to remember when you're looking at the data that we're about to present is that this is based on a variety of different paywall models. So there are many companies, for example, at one end of the spectrum that have hard paywalls, like the Times and the Financial Times in the UK, where you can access none of the content without paying for it, right the way through to some of the softer models like The Guardian, which has a membership or donation model where all of the content is free unless you pay for, and you have to donate voluntarily. So just bear that in mind when you're looking at the data and looking at some of the results that we see here. There is an enormous variety still of paywall models in usage, although that variety is getting smaller as publishers converge around one or two different methodologies. So what are some of the talking points that we've noticed in Q3 of this year? Well, we always start by talking about the New York Times. They are at the top of the list. They're still at the top of the tree when it comes to the data sets. And they seem to be continuing their relentless march towards the 15 million subscriber mark, having finally broken the 10 million subscriber mark, unequivocally broken it in the latest set of data that they've presented. And also, when you strip down into their results and look at the revenue line, it's clear that their top line revenue, the amount of money that they're bringing in as a business, will grow in 2022. And that's despite all of the noises that they're making about cost cutting across their business at the moment. And this is a very consistent pattern that we're seeing. Perennial second place, certainly consumer newspaper second place, the Washington Post, however, does seem to have stalled and seems to have stalled quite badly. It's reportedly struggling to add new subscribers. We've not had any reliable data from them for a while, but we do understand that their subscription efforts are suffering a little bit. It'll be interesting to see how they respond to that over the next few months. So really the question we have to ask ourselves is this it? Is the New York Times now going to have the market, particularly the American market, to itself? They have a dominant position in the US paid content market for news, and it seems as though they have ambitions to do that internationally as well. More broadly across the industry, we see no sign yet of a slowdown in subscriber numbers in the lag numbers from Q3. And remember that most of the numbers we're looking at here are lag indicators. They're not lead indicators. Michael later on is going to talk perhaps about some of the more leading indicators that we see in the industry. There is some forward-looking data that suggests that there is a slowdown along the way. You won't find any evidence of that yet in the numbers that we have for Q3. A reminder that the snapshot doesn't just cover publishing businesses, it also covers audio and video streaming businesses. And really in there, the key story is the continuing fight between Disney and Netflix for market leadership in the streaming world. Again, I would ignore most of the nonsense that you hear about Disney, the change of CEOs and all the rest of it. If you strip down to their data, they are still well on track to overtake Netflix. They'll probably do that next year. The key work for Disney is to improve their yields, which lag a long way behind Netflix's and account for the lower revenue that they generate from their streaming business compared to some of their competitors. So here are some of the big gainers that we've seen in Q3, some of the businesses that did best in the third part of this year. The biggest single grower that we found was Daily Wire, already a massive number, 48% growth in subs reported in the quarter to 890,000 subscribers. Now, this actually is a good opportunity to talk about some of the cautionary notes around some of the data that we find. There is no consistent standardized reporting for digital subscription numbers across the industry. We rely on a combination of publishers' own reports and their reported data in third parties. Nevertheless, this seems to be a pretty impressive performance from Daily Wire, but as with all of these single quarter massive growth numbers, you need to take it with a pinch of salt. You're never sure exactly where it came from. We continue to see very good performance from Axel Springer. Axel Springer have been one of the most consistent reporters of accurate data, and so they are a really good indicator of the underlying health of the industry, both built and developed their key brands, showing very good quarterly subscription growth rates, 4.5% and 8.5%. And if you want to use one company as a bellwether for the rest of the industry, they are a good one to look at, such as their commitment to not only the digital subscription business, but to reporting it consistently and accurately. A big jump as well for Brazil's Folha de São Paulo, which is up 20% since the start of the year, plays into another one of the themes that we've been mentioning all the way through the production of this digital subscription snapshot, which is that this is a global phenomenon. This is not a phenomenon that is unique to Western European and American markets. We do see not only the emergence of digital subscription businesses in other parts of the world, but we see their increasing success as well. Some good growth as well for some mid-table titles, El País and Süddeutsche Zeitung, neither of which have very large volumes, but which have shown pretty impressive growth results in the last quarter. And of course, there are still plenty of new entries coming into the report every issue. In this one, we had Clarín from Argentina, the very important Times of India brand in India reporting for the first time, Colombia's El Tiempo, the Arkansas Democratic Gazette, and many, many more. So there are still plenty of people coming into this market and reporting data for the first time and adding to our collective knowledge and understanding of the success of the digital subscriptions world. So here's the top 10, the 10 largest titles that we report in the snapshot. At the top of the list, as always, is the New York Times. Now, there's a little bit of a discrepancy there between my earlier figure of 10 million and the number that we have there. This is due to the way that they report subscribers versus subscriptions. I think that's the number of subscribers rather than the number of subscriptions that those subscribers have. Nevertheless, each quarter we also release an accompanying Excel spreadsheet that has all the underlying data, including the trend data, and there is a special tab devoted just to the NYT. So if you want to go and study that data in more detail, you can download that from our website. In second place, as always, the Wall Street Journal, the obviously more business-focused newspaper, continuing to show good growth at 3%. We spoke about the Post. The Athletic, we expect that their numbers will be rolled into the New York Times from the next snapshot. Then we have the Weather Channel, Guardian, Financial Times, Substack, Daily Wire that I mentioned earlier with that fantastic performance in Caixin. And the only real change in the top 10 in this edition is Nikkei, which has dropped out of the top 10 and is now, in fact, in 12th place, having been replaced by Daily Wire. But also to note is the growth of Barron's, which is not on this list, but Barron's has grown to the point that they are now the 11th largest brand in our list. These are the top 10 groups. Many publishers report their performance not only as individual titles, but in groups, showing that they're thinking about their performance across the whole of their portfolio, not just around an individual title. Some ones to pull out from that would be the likes of Gannett and Bonnier, and News Corp Australia, who have a number of very important news brands sitting within an overall umbrella. There is not much change here to report. The overall list of top 10 brands is exactly the same as it was before, but from that you can get a sense at a much higher aggregated level of the overall performance of some of those important companies. These are the streaming numbers I mentioned earlier. They show in third place Disney's continued growth. 10.5% in the most recent quarter, continuing to grow at the expense of Netflix, which was showing a decline, although it has since rebounded a little bit. The one to have some caution around there is Amazon. Amazon's true number is probably a lot higher than 200 million. We don't have a clear sight necessarily of what that number is. We certainly don't know how many of those people are using the Prime Video component that comes with their Amazon Prime subscription. But note also the continued prevalence of streaming services in China. Important not to forget that there are several Chinese market only streaming services that have considerable volumes. We must continue to keep an eye on their performance as well as the traditional Western markets as well. This is something that we pulled out last time, and I wanted to repeat it again, which is the digital subscription superstars. These are the companies and brands that have shown the largest amount of growth over a sustained period of time, and they are a little bit different from the list that you see in the traditional top 10. And I would just highlight the 4 of those as examples of businesses that have managed to sustain success and high growth rates over an extended period. To assess their success, we use this measure called CQGR. This is the compound quarterly growth rate. What does it mean? It means that if they had grown at a consistent rate every quarter from the start to the beginning of their data, what would that rate have been? So in the case of Tortoise, it would mean that they had grown at 30% every quarter consistently between 2019 and 2021. And the reason we pull that number out is because it provides a useful comparison for you with your other businesses. When you're thinking about the importance of your paid content strategy, think about it in the context of that quarterly growth rate and ask yourself, is there another part of your business that is growing as quickly as that? And the answer will almost certainly be no. So our four superstars so far this year: Tortoise, 30% growth rate; The Athletic, obviously the success of which led them to be acquired by the New York Times; El País, flying a little bit under the radar in Spain, but generating 100,000 new subscribers in just 2 years, a 14% growth rate; and the absolute outstanding performance in the UK market of The Telegraph, which in the last numbers that we had reported was 577,000. They have now reached 750,000 in their latest results, will be reflected in the next report. And they are the outstanding success story in the UK market at the moment. Just wanted to take a quick look at the New York Times' quarterly growth as a bellwether for the success of the industry overall. This is the change quarter on quarter for their volume, the number of subscribers that they have. You can see a big bounce in there in quarter one of 2022, which was the acquisition of The Athletic and some of the associated changes and reporting around that. But if you look at the longer term trend, this is perhaps the first place where we get a lead indicator of trouble on the horizon. Their growth rate has started to slow down significantly over the course of the last couple of years, down at around the 2% mark over the last 2 quarters. Nevertheless, still a reasonable growth rate for any business, but much lower than the rates they enjoyed during the height of particularly COVID, for example, and before, where they were achieving growth rates in excess of 6% regularly. So perhaps that's the first indicator of something a bit amiss with the subscription market, which Michael will talk to in a moment and see whether there's any further evidence around that. And there is just a slide that shows the continued convergence of Netflix and Disney Plus as those two lines come closer and closer together. So those are the key findings from the latest report. I'm going to turn my video back on. There I am. And I'm going to hand over to our guest for today, who is Michael Silberman from Piano, who's going to talk about the next phase of media. So Michael, over to you.
James, thank you so much. There's my slides. Let me move this out of the way. So as James said, I'm going to share some data from Piano's benchmarks. Also sort of compare some of the data that we're seeing in subscriptions to the data that's been recently reported about the advertising market, and then talk a bit about some of the sort of deeper trends that we're seeing in our data that suggest certain tactics that publishers should be thinking about as they try and focus on acquisition and retention, as James said, as the market starts to slow down off of its massive peak that we saw back in 2020. So, sort of 3 big trends that I'd say in 2022. First of all, subscription growth kind of coming back down to earth from the sort of stratospheric heights that it hit in 2020. Ad revenue growth is slowing, and I'll highlight some data from Magna about that, which just released its most recent global forecast. And then, of course, the sort of trend that we see nearly every week, a new report about media companies cutting costs in anticipation or in reaction to that slowdown in especially ad revenue. So what's been going on with subscriptions? This is 2021. And if you remember, we talked about this probably in early 2021. In 2020, we saw, I think the number was something like 57 in active subscribers from the beginning of 2020 through the end of 2020. So phenomenal year-on-year growth in 2020 that slowed down in 2021. Still a very strong sort of growth by the end of the year, 36%. But you can see in the sort of fourth quarter, starting around September, that growth rate began to slow. In 2022, that pace slowed further, but still, frankly, a very respectable pace of growth. 14% growth through November in terms of growth since the beginning of the year. These bars show the sort of cumulative growth in each month compared with the beginning of the year. So the beginning of the year would be 0, and then by the end of January, 2.8% growth. By the end of February, 4% growth, and so on. So solid growth, slower than what we saw before, but still quite respectable. Thinking about that question about, are we seeing any kind of leading indicators of where the industry is headed? Yes, slower, but you'll note that there was a sort of nice jump from October to November, sort of the biggest jump, month over month jump that we saw in the course of 2022. We think that that was because of the typical, sort of Cyber Monday, Black Friday sales that many publishers use at this time of year. And so that shows that there is absolutely still demand in the market, and that with the right offer out in the market, that publishers will see growth. We saw a similar sort of bump in November of 21. So slower, but still a nice, solid part of the business. So let's compare that to the ad revenue side. And this is not piano data. This is data from Magna, which does it forecasts U.S. advertising revenue growth every quarter, and then does 2 global forecasts in June and in December. And so if you sort of look at this data, these are the sort of series of forecasts, the past 5 forecasts that Magna has done. And as you can see, they got more and more pessimistic each quarter as more data came in. End of December a year ago, they were forecasting for 22, around 13% growth or so. They revised that downward in March. Once the Ukraine war started, they further revised that down in June, and did their first forecast of 2023. In September, they got much more pessimistic about 2023. And then sort of a slightly more pessimistic in the latest December forecast. So this is U.S. media owner ad revenue forecast across the entire industry. So this is television, this is print, this is out of home, this is audio, radio. So there's sort of all media types. Zooming out to the global forecasts, and again, there are only 3 of those to report on. Similar sorts of growth numbers to the U.S. forecast, actually slightly more optimistic globally compared with the U.S. For 2023. If you zoom in, though, and look at specifically publishing, so the FIPP membership, New York Times, other kind of media companies that you think of as being sort of piano clients or FIPP members, they're forecasting and have consistently been forecasting a decline for 2022, and a slightly less severe decline in 2023. So, the sort of broad takeaway is the advertising market is quite weak. And if you look at that compared with the sort of 14% growth that we've seen, and that's median growth across the piano client base in active subscribers, subscriptions continues to be a real bright spot for publishers, as James was saying. For any media business, seeing sort of continued growth in probably by the end of the year, the 15% range, perhaps even 16% range, to sort of have that kind of growth year over year at this moment in time is still quite positive and promising. So, how to think about this and the fact that things are slowing down, and that little bit of data that we have about November and the impact of those special offers and promotions. It's going to take more sophisticated targeting and marketing tactics to continue to acquire new subscribers. We'll dive into a bit of retention data in a minute, but the other thing is thinking about churn reduction tactics, and focusing on the sort of value exchange in terms of price versus the value of the product, in making sure that you're delivering that value and that you're keeping those subscribers. And then lastly, beginning to think about the ad business and the subscription business together, and how you might do that and sort of look at them together, looking at them as complementary to each other, and as opposed to sort of competing parts of the business. So let's talk a bit about acquisition. So to that point of how do we get more sophisticated about targeting? How do we begin to sort of dive deeper into where there's opportunity with particular slices of audience? One of the great places to start is beginning to dig more deeply into those conversion signals. And so this is a screenshot from a new report that we're releasing on the Piano platform for our clients that will show for those clients who are using our likelihood to subscribe algorithm, which is a machine learning that predicts each individual user's propensity to become a subscriber, rated on a scale from 0 to 100. This report shows some deep insights into that data. So how many users are in each of those buckets of conversion propensity? What's the relative conversion rate of those? What are the sort of different behaviors that we're seeing relative to, say, particular browsers or mobile versus desktop or engagement, so that you can sort of dig into that. And those kinds of detailed data give you more insight into the right tactics that you should be thinking about. So here's an example of that. This is the overall conversion rate for each of these buckets across our benchmark of all of our clients using the LTS machine learning. And what you can see by sort of looking at this data is that machine learning, that algorithm, is very, very good at sorting users by their predicted conversion rate. So, the users with the lowest score have the lowest conversion rate. The users with the highest score have the highest conversion rate when you actually look at their behavior. And it also sort of gets very steep at the end of the curve. So smaller audience, of course, in that 90 to 100 bucket, as we saw on that prior slide, but still a sort of highly engaged, highly likely to subscribe group. So a few things to understand about those folks, right? So they're a pretty small slice of the audience, only 0.4% of total visitors at the median across our client base. They only create about 3% of page views. So it's such a tiny audience. On the other hand, relative to the size of that audience, they consume a lot. They drive 20% of total subscription conversions. So that's a sort of unbelievably tiny but valuable audience that you want to make sure that you are targeting in the right way to make sure that those are the folks that you're asking to subscribe. Now, of course, you won't just want to focus on that tiny little audience. You want to expand it a bit. And when clients are working with us on our platform, we recommend, let's say a threshold of 60 or 70 as a sort of high propensity bucket. And then folks with scores lower than that would be a sort of lower propensity bucket. And you might segment in 2 or perhaps 3 different sort of chunks of audience, high, medium, low, or just high and low, to come up with different targeting strategies for each of those groups. To me, though, it gets interesting when you start to dig into the details of the kinds of things that we're looking at. This is the list of some of the key metrics that we pay attention to when we're trying to predict whether somebody is likely to become a subscriber. Right now, it's almost got 100, just shy of 100 different factors, features that we look at. But the model automatically sort of narrows it down to just somewhere around half to 2/3 of that feature set in saying that these are the most important things for this particular audience and this particular website. As you, though, think about that sort of targeting question, right, sort of unpacking that and understanding that relative to sort of generalized data is one of the sort of things to think about in terms of being more sophisticated. So it's not really a surprise that mobile users have a lower propensity in general than desktop users. And you can see really clearly on this chart that those users at the sort of lower end of the scale are more likely to be visiting on a mobile device. Those users at the higher end of the scale are more likely to be visiting on a desktop device. But this is another way of slicing that data. So it's saying, by score, what's the conversion rate based on device? And what you can see here is that the mobile conversion rate for that audience that is high propensity on mobile is not all that off from the desktop conversion rate. So think about it this way. If you had a simple rule that said all mobile users only get 5 page views, or are asked to register, not asked to subscribe, and desktop users only get 3 page views, and are always asked to subscribe, not asked to register, well, you would be leaving out a small but valuable slice of the audience on mobile that is highly likely to subscribe. And that's what I mean by starting to use more sophisticated tactics to be able to drive conversion, segment your audience, target your audience in the right way, make sure that you're putting the right offer in front of the right audience based on these sort of more sophisticated views of the audience. So again, using propensity combined with other factors that you might know about the audience, or ideal formats for trying to drive mobile conversion versus desktop conversion. Those are the kinds of things to be thinking about, because there's a sort of massive variance between the sort of high propensity and the low propensity users. And that's one of the sort of key factors that we like to take a look at. What's the difference in conversion rate between the highest propensity users and the lowest propensity users? And that difference tells you something also about the sort of potential impact of using propensity score as a value for targeting. Moving on, another way to look at it, of course, is engagement. We all know that those users who are more highly engaged are more likely to become subscribers. We've seen that data for a long time. But again, there's some nuance there. So you can see that even in this high propensity bucket, there are some users who only look at a couple of page views before they convert. Yes, there's a higher proportion of those highly engaged users. But then also in these sort of lower scores, there are some users who are quite engaged, but have a very low propensity to convert. They might be users who are consistently visiting from social, for example, consuming a lot of page views, always coming in via the side door, but unlikely to convert. Looking at that question, same way that we looked at the mobile data, even so, there are some users who have relatively low share of page views who still have a relatively high conversion rate. And certainly if you compare the sort of gap, the conversion rate gap of those high propensity users to the conversion rate of the lowest propensity users who are low engagement, there's an even bigger gap than there is for device, for mobile. So again, thinking about these factors in a more sophisticated way, targeting the right user with the right offer at the right time. Let's see. Yeah. Moving on to retention. So this is showing across the piano platform what kind of monthly subscription offer did the user convert on. So sometimes there's no trial. You just always have to pay full price. Sometimes there will be a paid trial, most often a relatively low price, say $1 or €1 for the first 30 days, sometimes a longer period, up to 90 days typically. And then, of course, some still use a free trial. So, completely free for the first month, and then you have to pay starting in the second month. And if we back this chart up, say to 2018 or so, the share of free trials would be much, much higher. It used to be a very common tactic, sort of popularized by Netflix and by some other players in the subscription space. It doesn't work very well for publishers for a couple of reasons. That share of those free trials has shrunk a lot over the past few years. One is the retention rate, that is that conversion from free to paid, is much, much worse for free trial than for paid trial. Paid trial retention rate typically is around 80 some percent, not all that different from that sort of first month conversion, not all that different from the month 1 to month 2 retention rate for a full price offer without a trial. Free trial is significantly worse. It's 70% or lower retention on that first month. So you sort of lose 30% or more of that audience when it comes time to pay. Combine that with the fact that it doesn't give you that much of a lift above the sort of paid trial approach. The math just doesn't quite work. And then the last factor is with some of the changes to regulations in markets like Germany, the introduction of the 3DS payment verification have made it much, much harder in certain jurisdictions to even offer free trials. So the combination of those factors has moved the market really towards paid trials, or in some cases, no trial. So I showed you some data about the sort of change from 2021 to 2020 on active subscribers. We're going to talk now about retention. So this is non-trial monthly offers. You can see, the sort of typical drop from the sort of new subscribers to how many are retained at that first month renewal mark. That's when we see the sort of biggest drop off again, say around 80% retention, drops a bit further in the second month, and then it begins to sort of level out to about a, sort of month over month, about a 5% churn rate each month after that. So that by the time you get to the end of the first year, you're somewhere in the 40 to 45% range of subscribers left at the end of the first year on a kind of monthly auto-renewing subscription. What you can see here is that if you compare 2020 retention to 2021, they're pretty similar. 2022 got slightly worse, although not significantly worse. It's still fairly close. So not a big impact that we've seen. And this has been a big question that a lot of our clients have been asking us. What's happening on the retention side is, the fact that of inflation and other sort of financial pressures causing users to cancel their subscriptions more often. We're seeing a little bit of that, but not really dramatically. If you look at paid trials, where, again, that sort of retention rate is a bit lower in that first month, closer to, around the high 70% range, 78, 79%, versus the sort of 80% range that we see for non-trials, the data looks quite different. And the sort of phenomenon that sort of comes out here, at least from our point of view, is 2020 was an outlier. That retention rates got significantly better, just in the same way that acquisition rates skyrocketed in 2020. People were much, much more likely to hang on to their subscriptions, especially in those early months, than they typically are. And so 2020 winds up looking like the real outlier and the difference. And that 2021 and 2022 are, sort of more typical kind of trend that we've seen with retention back in 2019 and that period. So, not really that much of a surprise that we would have seen a big impact, sort of positive impact on retention in 2020, just the way that we saw that huge surge in subscription acquisition. So how to think about retention and what's important. So one of the things that we frequently do with our clients is we will do surveys of their users to sort of ask them about subscription benefits and what benefits are most important to them. And so one of the benefits we always ask about, because it's a pretty typical media subscription benefit, is unlimited access to content. So when we ask that question, 80% of the time, that's ranked as the number one benefit that we do in this survey research. And 93% of the time, it's either the first benefit or the second benefit. So media products are fundamentally about the content, right? About access to the content. And so that's really the starting point of this, which is great content drives great acquisition and great retention. No surprise that the New York Times, one of the sort of most ambitious media organizations in the world, is seeing fantastic subscription growth and not really seeing a lot of challenges around retention. Great content equals great retention and great acquisition. So one of the other factors, that's really more about active churn. One of the other big factors, and that's sort of baked into those retention numbers that I was showing you, is passive churn. So that's where pretty much passive churn is credit card failure, some sort of payment failure, whether it's credit card, a debit card, or other payment method. For some reason, the payment has failed. And so we're launching some new features on the Piano platform related to passive churn mitigation. And so we've been digging more deeply into that data and gotten our hands on more data about passive churn and starting to understand that a bit better. And one of the things that we've been quite focused on is understanding the reasons for churn and how to take action in different cases. So at a high level, when you get sort of data back from the payment processor, from Visa or MasterCard, back from the payment processor, one of the things you get is a decline code, and they're typically bucketed as either a hard decline or a soft decline. And hard declines are slightly less successful at retries and recapturing those subscriptions, but not a lot worse. And so fundamentally, the sort of basic advice that we give is if you see some user have a passive churn, a payment failure, the first thing to do is retry their payment method. And you will see usually the first retry, second retry, sort of third retry, first few retries, you'll recapture a lot of value and get a lot of users back to becoming subscribers. If you sort of break it down from just hard decline and soft decline to the specific reason, you can see there are a lot of really, really confusing terms that don't necessarily tell you all that much. Like network failure, that's clear. Insufficient funds, that's clear. What does do not honor mean? Or a transaction not allowed. So some of these things are a bit confusing and not sure. There are certain kinds of payment failure that are much more common. Interestingly, the ones that are most common, network failure, call issuer, insufficient funds, have a very, very high success rate in terms of retries. Insufficient funds has more than a 50% success rate. Call issuer, it looks like it's around a 40% success rate. Similarly with network failure. So with each of these different reasons, right, there's sort of a different tactic to apply in terms of retry and sort of what you're going to do. And typically there are sort of two basic options, right, when you're retrying. One is simply retry the card or retry the payment method. The other is potentially send an email and try and prompt the user to take an action. So for example, if the sort of card number is changed or the card is expired, right? In that case, you're going to want to actually contact the user because there's going to be no way for you to just retry that card because it's not going to work. So, as you think about this, and this is new capability that we're releasing on the Piano platform, allows you to set different rules depending on those different decline codes. And fundamentally, the other thing to sort of keep in mind as you're thinking about this question of how do you get users to retry, how do you communicate with them, whether it's about a active churn, they've canceled their subscription, try and win them back to becoming a subscriber again, or passive churn, their payment has failed, you're trying to get them to take an action to, update their card, something like that. It's a marketing moment. It's a chance to sort of talk to the user in a kind of friendly, accessible way, a moment to remind them about the value of the subscription. If you approach them that way with sort of human language, not kind of something that sounds like it was generated by a machine, card failed, please update, then you're going to have a lot more success. Just a sort of last thought to leave you with, I mentioned the idea of beginning to think about ads and subscriptions together. And we think that that's really the sort of future. As I said, much more sophisticated targeting, dynamic rules. James was talking a bit about that. The sort of paywall rules are getting much more sophisticated. How you're targeting different segments of users, being very, very smart about letting users who aren't quite ready to subscribe to sort of continue to read and get to know the brand, to the point where they are really willing to be subscribers. But then also starting to understand the value of particular users relative to ads, or the values of particular content relative to ads, and factoring that into the decision about whether to put up the paywall for a given user or to lock a particular article. That's really what we see as the future of all of this, and some of the work that we're going to be doing in 2023 to create features that enable that. So that's what we've got for today. And I'll hand it back over to James.
Thank you, Michael, for that. That was wonderful. Really interesting conversation, really interesting presentation, and picking up on some of the points that we spoke about when we met last week. I just want to ask you a couple of questions before we finish up, though. The first one is, when you think about all the data together, because you've had some ad data in there and obviously a lot of data around subscriptions, do you think there's a danger that we're talking ourselves as an industry into a recession a little bit? Because do the indicators really say that there's a recession coming here?
Yeah, I think it's a good question, right? We're sort of, as an industry overall, we're making cuts in staff and so on, sort of cutting budgets. That's happening not just within the media industry, but in other sectors as well, certainly in tech broadly. And yeah, it can be a self-fulfilling prophecy. If you start firing people and they can't find a job, well, that's going to mean they're spending less money and perhaps lead us into a recession. The U.S. Fed, I think earlier this week, or maybe last week, sort of sounded increasingly optimistic that maybe we're going to have a soft landing, maybe a sort of slight economic slowdown, but not a recession. And the U.S. stock market seems to have, at least this week, kind of decided that might be the way things turn out. So we'll see. I'm not an economist, so I'm certainly not an expert in predicting that sort of thing. But the economists aren't very good at it either.
No, we're not economists, but we're optimists, Michael, is what it is. So that's we're optimistic that there's no recession. The other thing, and this is something we spoke about when we met in person, are you kind of encouraged at the degree of sophistication we're seeing in digital subscriptions now? Because from the data you presented and from the information you presented, these strategies are getting quite complex now. I mean, what does it show? So I think some of it shows, sort of increasing technical capabilities. So just the sort of piano software certainly has gotten a lot more sophisticated over the past few years. I think in general, publishers also, having done the basics, are now sort of realizing, okay, there's a more nuanced way to approach this. We don't need to be one size fits all. We've had some folks that we've talked to have been in the sort of
hard paywall camp who are starting to say, maybe that's not the best approach. And maybe we should be sort of thinking about a more aggressive sampling strategy and figure out how to grow our audience again and nurture subscribers. So it's a understanding that again you can do, and that you can be smarter about it, and sort of make the right offer to the right user. The other thing that we're seeing more and more emerge is interest in bundling strategies. So, sort of multiple products under a single brand, or multiple websites under a single, sort of parent company, and beginning to sort of bundle things together. New York Times being, again, the sort of most prominent version of that, but then also Disney's been doing that with Hulu and with ESPN. So seeing some interesting trends there as well.
Yeah, absolutely. I thought the paid trial data that you presented was really the killer data, wasn't it? I mean, that should tell everybody that their subscription, their paywall strategy needs to incorporate the ability to do that, right? Otherwise, they're not going to succeed.
Absolutely. Yeah. No, that's very clearly table stakes strategy, and different companies have different strategies there as well. There's the sort of first month or first couple of months at a lower price. There's also introductory offers are quite common. So first year will only cost you X, and then it sort of increases over time. So we're also starting to see that in digital subscriptions. When in magazines for years, there's been that sort of step up pricing strategy, sort of get somebody in on a low offer and then sort of gradually increase them over time to maybe, triple the price that they paid at the beginning, or 4 or 5 times the price that they paid at the beginning. We're beginning to see that sort of strategy come in on digital subscriptions as well. And that's another capability that we're adding to the Piano platform. We have a number of clients in beta offering that ability to have sort of more sophisticated pacing of how subscriptions increase or potentially decrease over time.
Yeah. And the bundling thing is interesting as well. Of course, a very long-established tactic in the print world now coming to digital as well, which is fascinating. Michael, we're out of time. Thank you very much for that. Really appreciate you taking the time to come and present that to us. Thank you to all of those of you who are watching both now and on YouTube later. A reminder that this video will be edited together and put onto the YouTube channel very, very shortly. A big thank you to Michael and to everybody at Piano for their support in making this webinar happen, and also for the support around the quarterly digital subscription snapshot. A reminder, you can download that from the FIPP website, where you can also subscribe to our newsletter, which is the best way to keep abreast of everything that we're doing. But we've run out of time for this session. It only remains for me to say thank you once again to Michael. Thank you to all of you for listening, and we'll see you all again soon. Thank you and goodbye.